Mastering Trading Psychology, the science of human behavior in financial markets. Human behavior shapes every movement in the financial markets. Charts, indicators, and economic reports matter, but the real battle in trading is psychological. This chapter dives deeply into trading psychology with a high education approach, exploring behavioral finance principles, cognitive biases, emotional regulations, mental frameworks, and the development of a sustainable trader mindset. What is trading psychology? Trading psychology refers to the study of how emotions, cognitive patterns, and mental processes influence trading decisions. Markets are not only governed by logic but also by fear, greed, impulsiveness, overconfidence, regret, herd behavior. These emotional and cognitive elements often overpower technical or fundamental analysis, leading to inconsistent outcomes. A high education understanding of trading acknowledges that traders are not perfectly rational agents. Instead, they are vulnerable to subconscious biases, emotional turbulence, and the neurochemical responses triggered by stress and uncertainty. Why trading psychology matters more than strategy. Most beginners think profits come from indicators or strategies. Professional traders know the opposite. Your psychology determines your performance more than your strategy does. Reasons why psychology dominates trading. Markets are uncertain and uncertainty triggers emotional responses. The brain is wired for short term survival, not long term probability based decision making. Losses psychologically hurt twice as much as gains feel good, a phenomenon known as loss aversion. The presence of money enhances emotional sensitivity, triggering fear or greed. A technically perfect strategy executed with a weak mindset will fail. A mediocre strategy executed with strong discipline can succeed. Behavioral finance, understanding the mind of a trader. Behavioral finance explains how human psychological tendencies lead to irrational financial decisions. Here are the main biases that impact traders. Aversion. People prefer avoiding losses over acquiring gains even when the reward is statistically favorable. This causes traders to cut winners early, let losing trades run, avoid taking calculated risk. Second is confirmation bias. Traders seek information that supports their existing belief while ignoring contradictory evidence. Example, a trader who thinks a stock will rise keeps reading bullish news and ignores bearish signals. Third, overconfidence bias. Traders overestimate their skills after a few wins, leading to excessive position sizes, ignoring risk rules, impulsive trading. Overconfidence is often the cause of the blow up phase, where traders lose accumulated profits in a few reckless trades. Anchoring bias. The mind fixes itself to a particular number of forecast. Example, a trader buy a stock at rupees 1000 and mentally anchors to this price, refusing to accept a stop loss at rupees 950. Fifth is herd mentality. Traders imitate the actions of the majority because the brain is wired to follow the group for safety. This leads to buying at market tops, panic selling at market bottoms, falling into hype cycles. Emotional hijacking, the neuroscience behind trading mistakes. The human brain has two primary regions influencing trading. First is the prefrontal cortex, analytical brain, responsible for logic, planning, risk assessment, and decision making. Second, the amygdala, emotional brain, responsible for fear, aggression, impulsive reaction, and survival mechanism. During stressful trading events, for example, sudden market drops, the amygdala overrides the logical brain, causing irrational panic selling, revenge trading, hesitation during entry exit, FOMO buying. This is called amygdala hijacking, and mastering it is the trader's greatest challenge. The five major emotional states in trading. First is fear. Fear leads to paralysis, Traders hesitate, miss opportunities, or exit too early. Second is greed. Greed creates the unrealistic expectations and encourages traders to over leverage or chase markets. Third is FOMO. Fear of missing out causes the traders to enter late when probability is already low. Fourth is hope. Hope keeps traders holding on to losing positions instead of closing them rationally. Fifth is frustration. A series of losses leads to revenge trading, which is emotionally driven and statistically disastrous. Developing emotional discipline. Professional traders train their minds like the athletics train their bodies. Techniques for emotional control. First is pre trade routine. A structured routine reduces impulsiveness. It may include analyzing key levels, reviewing risk parameters, meditating, or breathing exercises. Fixed risk per trade. When you predefine risk, emotions reduce significantly. Journaling trades. Writing the reason behind each trade reveals patterns of emotional decision making. Mindfulness training. Techniques like meditation, visualization, and grounding strengthen emotional balance. Building a probability based mindset. Good traders think in probabilities, not certainties. Characteristics of a probability based thinker: accepts losses as normal, focuses on long term outcomes, avoids emotional attachment to individual trades, uses statistical as instead of prediction, understands randomness in market fluctuations. This mindset transforms the trader from a gambler into a systematic decision maker. The psychology of losses and drawdowns. Losses are inevitable. What matters is how you process them. Professional handling of losses, viewing a loss as data, not failure, reducing trade size during losing streak, staying patient instead of immediately trying to recover, evaluating whether loss was due to strategy or psychology. Drawdown test mental stability. Many traders quit during the drawdowns not because of money but because of psychological fatigue. Building long term mental resilience. Long term trading success relies on mental endurance. Three pillars of mental resilience. First is self awareness, understanding your strength, weakness, and internal patterns. Second is emotional stability, maintaining calmness during volatility and uncertainty. Third is adaptability, modifying strategies and mindset as market conditions evolve. Conclusion: psychology is the foundation of every trader's journey. Mastering indicators is easy. Mastering chart is easy. Mastering psychology is what separates beginners from professionals. In this chapter, you have learned how emotions affect decision making, major cognitive biases in trading, neuroscience behind trading behavior, how to build emotional discipline, how to think in probabilities, how to handle losses and drawdowns, how to develop long term psychological resilience. Trading psychology is not a one time lesson, it is a lifelong practice.